Okay, so I'm going to go through the questions in the sample midterm exam. Okay. So this is the exams I used for the spring term on the same course. Okay. There are 25 multiple choice questions. So I'm going to go through each of them, one of those, and give you the answer. And on something important, I may also provide with more detailed explanation. So here, the first question, a publicly accountable corporation that prepares financial statement for its shareholders using IFRS would be best described as, the answer is following Canadian GAAP, okay? So basically, there are different GAPs, right? Different GAPs. So GAAP means generally accepted accounting principle. So in Canada, IFRS and ISB are both GAAP, okay, are both GAAP. So disclose the basis accounting. This is not a GAAP, okay, this is not a GAAP. So in Canada, publicly accountable corporations, okay, they are required to prepare financial statements according to IFRS, right? And this is to follow Canadian GAAP, okay? Providing special purpose of financial statement, okay? So the common financial statements are the four types of statements, right? Special purpose financial statement you have not seen yet, okay? So for this kind of things, you may not learn. Maybe you will learn some in auditing courses, but in the financial accounting, maybe you may not see a lot of the special purpose financial statements. Using ISB, okay, using ISB, that's for the small and medium-sized enterprise in Canada. Okay, they have the option to use either ISB or IFRS, but for publicly accountable corporations, they have to use IFRS. Question 2, which one of the following corporate reporting objectives would be best served by an accounting policy of recognizing expenses close to the time they are paid for, okay? So you recognize expenses close to the time they are paid for. So you're recognizing expenses close to the time of the cash payment, the cash outflow, right? So then what happened is, if your expenses, okay, is recognized when or close to the time the cash payment, the cash outflows, okay, you can use your income statement, right? Remember, expenses, those are on your income statement, right? To predict cash flows, right? If the expenses timing recognition, the recognition of the expenses timing is very close to the timing of the cash flows, okay? So then you can use the income statement to predict cash flows, because on the income statement, you can see the expenses, right? Okay, and then you can approximately use those expenses, consider them as the amount of the cash outflows, because the timings between the expenses recognition and the cash outflows are very close, right? If, okay, for the cash-based accounting, revenue or expenses are recognized always when there is a cash inflow or cash outflow, right? So that's the cash-based accounting, okay? The recognition of expenses and revenue, okay, the closer to the timing of the cash flow or cash flows, the better you can use the financial statement, especially the income statement, to assess and predict cash flows. C, contract compliance. Okay, what is this? We have learned that when you borrow money from the bank may attach a covenant, right? A covenant. So in this covenant, they may specifically require the borrower to meet certain level of debt to equity ratios. So the bank does not want the borrower to borrow money over excessively, okay, over excessively. Because for companies with huge amount of debt, they are more likely to go bankrupted, right? So the bank wants to make sure they are lending money to the healthy companies, right? So they would, in the bank covenant, in the debt covenant, they would specify maybe a debt to equity ratio. If you go over this threshold, the bank have the right to recall the principal of the loan, right? So therefore, the managers of the company have the reporting objectives to comply with the contract requirement, right? So contract compliance is one of the reporting objectives, okay? But this is not achieved. This is not achieved by timely recognizing expenses. Okay. D, performance evaluation of managers. Okay. So maybe the managers are evaluated based on their annual earnings. Okay, the company's annual earnings. So the manager have a motivation objective to manipulate the earnings upward, right? To make the earnings looks better, so that they can probably get a good raise, right, in the salary. So the answer for this question is B, right? Is the B. Number 3, which of the following corporate reporting objectives would be best served by accounting policy of deferring expenses as long as possible? So let's think about this accounting policy. You defer expenses as long as possible. So you don't want to recognize expenses now. You would rather to recognize expenses in the future, okay? In the future. So if your expenses is not recognized now, so your expenses is understated, your income will be overstated, right? Okay. If your reporting objectives is income maximization, okay, if your goal is to maximize the amount of income to be reported, and then this accounting policy is a good choice, right? Right? The accounting policy of expenses defer would be a good accounting policy to serve the reporting objectives of income maximization, right? Number 4, XYZ owns some equipment that as of the current period can no longer be used in production and has no scrapped or resale value. The net book value of this equipment should be, okay? So here, think about the definition of the eyesight. 3, right? 3 things. Entities control, right? And the past events, okay? And the future economic benefit. Do you think this equipment have the future economic benefit? The answer is no, because the equipment as of current period can no longer be used in production. It will not bring any future economic benefit. So this equipment is not an asset. So you have to de-recognize the equipment, right? You have to de-recognize the equipment. And then there is a net book value, right? So suppose the net book value of the equipment is 100 on your book. So on your book, you believe your net book value is, your book value of the equipment is $100. The equipment is still worth $100. However, it can no longer be used in production, and it does not even have a resale value. So that means it is really worthless, right? Valueless. So therefore, you have to write off the net book value, right? You believe it worth 100, but sorry, you can't resell it for 100, right? It's $0 value. So then you recognize a loss in the current period, right? A loss in the current period, and de-recognize this eyesight. So the answer is A. The answer is A. Question number 5. PDQ Corporation discovers in January 2015 that a customer who owes them $60,000 has become bankrupted after several months of financial distress. The financial statements for October 31st, 2014 have not yet been submitted to the board of directors for approval. So there's no signature yet, okay? So they are preparing the financial statement as of December 31st, 2014. And these documents have not been signed by the board of directors yet. So now this period is called a subsequent period, right? Subsequent event period. So this event, January 2015, a customer has become bankrupted. This is the subsequent event. Okay. So after several months of financial distress, okay, so maybe even before December, the company PDQ probably know that this customer is gonna go bankrupted, right? So maybe they recognize the bad debt expenses already, right? So they recognize this is the anticipated uncollectible, right? So they're gonna recognize this as, they're gonna recognize this as part of the allowance for doubtful accounts, right? Now, in the subsequent event period in January, the customer now has become bankrupted, okay, You have this information, and this information is gonna help you to measure, right? So now you know that for sure, this amount will not be collectible, so you have to write it off, okay? So you have to adjust the financial statement for this event to write off this client, okay? And you are going to disclose this as a subsequent event. Does that make sense? Okay. This is question 5. Question 6. For the current year's financial statements, cash received from a customer for work to be done the next year would affect, the answer is the balance sheet only. Think about what's the journal entry. So in the current year, you received the cash, right? And the work has not been done yet. So you debit cash, credit unearned revenue. Cash is an asset, okay? Unearned revenue is a liability. So this journal entry only affects asset and liability. Therefore, it's only affect the balance sheet, right? It's only affect balance sheet. Question number 7. Expensing rather than capitalizing and depreciating 50,000 of garbage cans for a company with 1 billion total asset would be an example of which of the following qualitative characteristics. The answer is A, cost of benefit, right? So the company has a total asset of $1 billion, okay? And you are struggling with $55,000. So $50,000 is nothing compared to 1 billion, right? So whether you record $50,000 as an asset or as expenses, it really does not affect much, right? Because the total asset is 1 billion. And you are talking about a small asset of 10 billion, 50,000. So this is about cost of benefit, right? Cost of benefit. What's the benefit to including that $50,000 as asset versus expenses? If your total asset is 1 billion. And what's the benefit? And the cost is you hire CPA, right, to book this as asset, right? And then you do the amortization, depreciation. It's going to take you time. So the additional cost does not justify the benefit. So this is from the perspective of a cost-benefit criteria. B, completeness and neutrality. This is really about representational faithfulness, right? Representational faithfulness. Okay, that's number 7. Number 8. Creamly Incorporation has opening return earnings 175,000 for the 2013. For the 2013 fiscal year, it reports 25,000 net income. Dividend declared in 2013 were 55,000. That will be paid in 2014. The closing return earnings balance for 2013 would be, well, closing balance equals opening balance plus net income minus dividend. This is the equation you should have learned from 2100, right? So closing equals opening plus net income minus dividend. So in this case, 175, okay, plus 25 minus 5, we get 195, okay, 195. Question 9, management motivation to increase the likelihood that the company will receive a 50,000 government rebate. Best illustrate which of the following. So earnings management. So basically, the management are motivated, okay, to increase their chance of receiving government rebate, okay? So they want to do something about the earnings, okay, so that they can secure that government rebate, right? So that's earnings management. Number 10, which statement appropriately explains the meaning of publicly accountable enterprise? Okay, so the answer is B. So firms with equity, debt, or other securities traded in public markets. So publicly accountable, okay? So the enterprise is publicly accountable. Why? Because the public purchased their shares and debt, equities, right? And that has to be done in an open market, right? So in Canada, for example, Toronto Exchange stock market, right? So in that case, there are, let's say, Canadian Tire, Shaw Cable, right? Investors all buy equities from them. So they are considered as publicly accountable enterprise. Okay. Question 11, which of the following statement is not correct? Information asymmetry means someone have more information than others. That's correct. Moral hazard refers to a situation where one party cannot observe the actions of another party. That's right. Adverse selection refers to a situation where one party have information advantage over another. That's correct. Okay. D, okay, cheap talk. The reason why it's cheap is because it's costless. It's not costly. It's not costly. It's costless. That's why it's called a cheap talk. Okay. So the wrong answer is D. Okay, D should be selected because it's wrong. Cheap talk is costless, doesn't cost you anything. Question 12, which statement is not correct? The answer is D. Financial accounting is a process of providing information to external parties, not internal parties. Okay, external parties, not internal parties. So like question A, answer A is correct, right? Answer B and C are both right, okay? 13, the underlying fundamental objective of accounting conceptual framework is decision usefulness. Everything you are doing, you are trying to make informed, useful information, right? So the whole and fundamental objectives of the IFRS framework is to be useful for decisions. Question 14, which is not a qualitative characteristics of financial information in the IFRS conceptual framework. Okay. We know understandability is the enhancing level, qualitative characteristic. Representational faithfulness, that's the fundamental, right? Together with relevance. Both are fundamental qualitative characteristics. Comparability, that's the enhancing qualitative characteristics. So the answer is B, historical cost. This is just a measurement. This is just a measurement. Question 15, which is not a criteria for recognition of financial information in the IFRS conceptual framework. Excuse me, I think I need a nap. Okay, what time is it? I really need a nap. So which is not a criteria for recognition of financial information in the IFRS conceptual framework? So if you open your textbook following the chart, you will see that for the recognition of the financial element, the amount has to be reasonably measured, and the inflow and outflow of cash are probable, right? What does that mean? What does that mean is, if you cannot measure something, right, then you cannot recognize it. Right? Remember, I give you the example. What is the value of the university president? Right? If you're not able to measure it, okay, with a reasonable number, then you should not recognize it. Okay. If you are able to measure it, okay, but if the cash inflow or outflow are not probable, then you should not recognize it. Okay, then you should not recognize it. So for example, the bad debt expense, right? Bad debt expense. If you know there is one customer who is going to file bankruptcy, okay? So the inflow or outflow of the cash are not probable, right? Are not probable, right? So in that case, you should not recognize it, okay? You should not recognize it. If you happen to already, include this amount into AR and loss for doubtful account, because the future inflows of collecting that balance is not probable, okay? Therefore, we should not recognize that account receivable, okay? So that's why in order for recognition, okay, first you have to be able to measure it, right, reasonably, you have to be able to collect the cash flow, right? And number B, the expenses should be matched with revenues. Okay, then we don't have any problem with this, right? This is a matching principle for recognition of expenses. That means you recognize the revenue, but if for matching purpose, you have to recognize expenses. So the answer is C. The amount must be measured at historical cost. So this is not right? Okay. So for example, we learned about remember last lecture where I was comparing the differences between ISB and IFRS. So under IFRS, okay, the biological assets such as dairy cow has to be reported on the balance sheet using their fair value, okay, and the changes in the fair value over the year, okay, is considered as revenue or expenses, okay. So the point of that is the amount must be measured at historical cost. That's wrong because there are some alternative ways of measuring, such as fair value method for the biological asset. So this is not right. So the answer is C. Okay, question 16. Which statement best explains the qualitative characteristic of relevance? Okay, which statement best explains the qualitative characteristics of relevance? The answer is C. Information should influence a user's economic decisions. Okay. So let's take a look at A. Financial reports should be understandable to the users of the information. So this is the enhancing qualitative characteristic, which is understandability. Question B, omitting information will influence a user's economic decision. Omitting information, that's completeness, right? Completeness, that's part of the representational faithfulness, okay? D, financial reports should be accurate and complete. Again, this is representational faithfulness. Only C, okay, is relevancy. It's about influencing a user's economic decisions, okay? Remember the example I gave you that the Vancouver land, right? If you purchase the land for 1 million, the fair market value is 10 million now, right? So which number is relevant to your current decision making, right? Of course, it's the current fair market value, right? So in this case, the $10 million is gonna affect your decision, right? The $1 million, it was old number. It's reliable, but it's not relevant. Okay, the current fair market value, okay, is gonna affect my decision. Okay, so basically, relevancy is really about whether the information should influence a user's economic decisions. Question 17. Which of the following is an attribute of representational faithfulness? Okay, the answer is C, neutrality. Okay, neutrality. A, historical cost, that's a measurement, right? That's a measurement. B, confirmatory value, that's a relevancy. D, understandability, that is enhancing qualitative characteristics. Neutrality, that's a representational faithfulness. The answer is C. Question 18, in which of the following transactions would it not be appropriate to recognize eyesight in the financial statement? The answer is A. So SGG received a firm commitment from another company to purchase goods from SGG. It's just a firm commitment, okay? Would you recognize the eyesight? Okay, if you want to recognize the eyesight, for how much? Okay. And let's take a look at B. SGG pays 10,000 to a lawyer for service to be provided next year. What's your journal entry? Okay, you debit prepaid for the legal service. 10,000, you credit cash 10,000. So you recognize the cash 10,000, right? You recognize the prepaid, right? So it's appropriate to recognize the prepaid for B. C, SGG provides the service to another company, but will not be paid until after the year end. Okay, so if you provided the service, okay, you're gonna recognize AR, right? You debit accounts receivable, right? Again, you recognize the eyesight in the financial statement. So C is okay. D, a customer of SGG makes a deposit of 1,500 for goods to be custom made. So SGG has to recognize the receipt of the cash. So you debit the cash, okay, for 1,500. So you recognize the cash asset, right? The only thing that does not fit into it is not appropriate is A, okay, the firm commitment. Why? Because how to measure it? Can I reasonably measure the commitment? Okay, and then is the cash inflows, is that cash inflows probable? If the answer is no, then you cannot recognize this item. Okay. Question 19, which organization oversees accounting standards in Canada? So CPA Canada, CPA Canada. 20, assume that a company has a calendar year of January 1st, 2021 to December 31st, 2021. March 15th, 2022 was the end of the period for gathering information pertaining to financial statements. The financial statements were authorized for issue on March 24th, 2022, okay? What is the cutoff point for the recognition of transactions and events in a reporting period? And we mentioned this in the class, that is the cutoff date, right? December 31st, 2021, okay? However, the cutting point for the measurement purpose, that goes to the signature date, March 24th, okay? Question 21. Question 21. The Rihanna company owes 1,000 shares in Abihi Corporation, a public company listed on the stock exchange. The share price was as follows. At the date of purchase, the cost is $100 per share. At the year end, June 30th, 2022, the share price remains the same. At the start of next fiscal year, June 1st, $5 decrease in the share price. At the date financial statement authorized for use, September 1st, 2022, the share price now decreased to $90, okay? So materiality for this company's financial statement is $500,000. What is the appropriate treatment for the subsequent event in June 30th, 2022 financial statement? Well, the share price for June 31st, 2022, the year end, is $100. Okay. So whatever the share price after that date has nothing to do with the fact that the share price is $100 per share on that day, right? I don't care how much the share price is going to drop, right? The day after. Okay, am I correct using $100 per share as the share price for the date of June 30th, 2022? The answer is yes, right? That's how much the share called worth on that date, okay? So you don't have to do any adjustment, right? You don't have to do any adjustment, right? You don't have to. So for the note disclosure, okay, is this price change significant? Okay, so on September 1st, 2022, the share price is $90. So compared to the year end, 2022, June 30th, every share lost $10. And there are 1,000 shares. So in total, you lost $10,000. Is that material? No, because materiality is $500,000. So $10,000 is not material. So therefore, you don't have to disclose it. Okay, you don't have to disclose it. So no adjustment. Okay, no disclosure. Okay. Question 22. Which of the following is an example of an error that should be corrected? The answer is C. If the company's procedure manuals want you to use 1%, but you use the 5%, that's an error you made. You should have known better. It is 1%, not 5%. So this is the error. Let's take a look at A, switching from straight line to the declining balance method of depreciation. So that's a change in accounting policy. Question number B, changing from weighted average to first in, first out method of inventory valuation. Again, this is the change in accounting policy. D, starting to capitalize fixed asset under $1,000, which were previously considered immaterial. Okay. So this is a change of policy. Previously, the capitalization policy is $1,000 has to be over $1,000. Okay. But now they start to capitalize fixed asset under $1,000. So this is a change in policy. 23, which of the following is an example of a change in accounting estimate? So the answer is C. Answer is C. So you use 5% of allowance for bad debt because of the increased possibility of bankruptcy of the customers, right? So the increased possibility is a new information, right? So therefore, you change the percentage to 5%. That's a change in estimate, okay? 24, which of the following is an example of a change in accounting policy? The answer is A. So changing from weighted average to FIFO, that's a change in accounting policy, okay? C is a change in estimate. D is a error of correction, okay? B, capitalizing a delivery truck that had previously been expensed. This is the correction of error, right? Correction of error. Last, the method of depreciation was changed from double declining method to straight line method. So this is a change in accounting policy, okay? So therefore, you have to make retrospective adjustment for the previous years, okay? That's including the initial year of the machine acquisition, 2020. So 2020 and 2021, all the previous years has to be adjusted, okay? That's it. That's the 25 multiple choice questions.